Former Dallas Fed President Robert Kaplan joins us this morning to talk about what we might hear later on this morning. Robert, it's great to have you. I imagine you don't expect the chair to be nearly as declarative as Harker was yesterday.
No, I think he's going to try to be neutral, say progress is made, but the job's not done, and keep his options open, be agnostic about what they're going to do next. And there's a bunch of cross currents that are going to create a lot of debate through the fall. Manufacturing's weak. Anything interest sensitive is weak. It's hard for a small business to get a loan right now. China's weak, as you guys mentioned. However, you've got substantial government spending, Inflation Reduction Act, Infrastructure Act, unspent ARPA money. Services are resilient. And so these cross currents are going to have to sort through the fall. And the other thing that's going on, which I think you also mentioned earlier, is the back end of the curve. Rates are backing up. That's a tightening away from the Fed. And so if I were at the Fed, I'd want to observe that carefully and see how that plays out, because it may have further to go. And that could be a more significant tightening than anything the Fed might do.
Robert, if the Fed has such a wide range right now that it's looking at for a neutral rate, how can they really be sure that they're either restrictive enough or not too restrictive to get to their long-term goals? So
it's a central question I know that they're wrestling with, and I would be wrestling with. The tricky part is, without, again, this sizable project spending by the government, or government-enabled project spending on manufacturing and infrastructure, I would think the neutral rate organically is something like 0.5% or 0.75% in the economy. The thing that's tricky is, if that's true, then why is the economy so strong? But I think there's an X factor, which is government spending, which is sort of confusing how much of the neutral rate is organic and how much of it is artificial based on this government spending. That's why I would really make sure I had a good grip on what the forward calendar is for this project spending from Inflation Reduction Act, Infrastructure Act, and so on, because I think it may make it look like the neutral rate's a little higher than it actually is.
Robert, that being the case, and also the fact that Chair Powell has acknowledged that in all likelihood the Fed will at some point be cutting rates before inflation is all the way back to its target. What do you think he's going to be able to say about just how the Fed is going to be making its decisions? What is its reaction function to incoming numbers in terms of inflation, and how are they perceiving the risk that perhaps that over-tightening is a possibility?
So potentially today, but certainly over the next few weeks, you're going to hear more about this subject that Courtney just asked about, the real neutral rate, and the difference between the nominal Fed funds rate and the real Fed funds rate. And the point is, if they keep rates where they are, for example, for the next number of months, but inflation weakens a little bit, that will actually mean that the real rate of interest has actually gone up. And so they may feel, if inflation's improving, that they have latitude to cut a little bit and still be as restrictive. That'll be the kind of thing you're going to hear a lot of wrestling with over the next few months.
Robert, I've seen some work looking at the relationship between CPI and PCE, looking at what healthcare is doing versus what shelter might do, and arguing that that relationship could flip. And I wonder, are we going to be paying attention to one metric more than the other in the quarters ahead?
I think sitting at the Fed, I'd be looking at everything. You look at all these metrics, and I'm also very conscious of some of these structural drivers, which is the subject of this conference. Workforce growth is decelerating due to aging. We don't have enough workers, and you're seeing that in wages. We're also gone from globalization to deglobalization, and we're not using trade as strategically. That'll show up in the numbers. And the big one is the energy transition, which is going to cost trillions globally and is very expensive. And so keep your eye for the next number of months, for example, on energy, because I still think we're 3 or 4 years away from peak energy demand globally for fossil fuels. And the energy transaction is going to take a longer time than maybe some people think. and you may see that feed through and make inflation stickier.
Yeah, Goldman did some work on that this week, looking at if we just say we get oil to 100, they argue it could add maybe a tenth or two to headline. It's a district, obviously, you obviously know well. I wonder how much of a threat you think that does pose to headline.
I think we should be prepared that you could get more spikes in oil prices, and I would, based on everything I see and talking to contacts, we're undersupplied relative to demand globally, so we're vulnerable to spikes. The one other structural issue that I'd point out, which is sort of stating the obvious, we're a lot more leveraged today than we were pre-COVID. I mean, the government indebtedness is now over 100% of GDP, and I think that's why this backup in yields in the long end of the Treasury curve, I think, is more about supply of treasuries this year and for the next number of years, and who's going to buy those treasuries, than it is about strengthening the economy. And I think that's a structural development that's worth watching closely.
Robert, a few years ago, I guess now, Jay Powell at Jackson Hole gave a speech that gave a lot of credit, reminded us of Alan Greenspan in the 90s, his willingness to allow the productivity growth of the economy to essentially help him set monetary policy and sort of give the economy more room to grow faster than maybe it otherwise would have. Is that relevant right now? We're talking about AI, what it's going to mean for the potential for productivity growth?
Yeah, it's relevant, and you'd like to believe, and I'd like to believe, that AI and technology will lead to more productivity. We've got slowing workforce growth. We need more productivity. The issue is our educational attainment needs to be improved, in that early childhood literacy scores, our educational attainment scores are lagging the rest of the world, and post-COVID they've deteriorated a little bit more. If we're going to take advantage of this AI revolution, I think we need to be focused a lot more on improving educational attainment, because yes, productivity improvement would certainly help with better GDP growth and also with fighting inflation.